When you compare then interest rates, which were high in the 80s to now, something that policymakers and central bankers don't often talk about, or in fact ever talk about, because it's ultimately the banking model, is that there wasn't so much private debt in the economy in the 80s as there is now. As soon as you start tweaking interest rates, the economy capitulates because of all the stuff that we know. And all the stuff we know is we've got subprime auto, we've got subprime real estate, we've got margin debt for the stock market, we've got crypto out of the... All these things, all these exotic financial products that weren't there in the 80s. How different does that make it a landscape for the central banker to try and navigate?
Super difficult. If you have to imagine, we had a massive crypto boom the past 2 years, and they were not just smart investors, they were also investors who said, okay, I go to the bank and get a loan of 20 grand and I buy some Bitcoins or Ethereum for that, and now they're in. The other problem is we've got I say, well, we are living in a leasing society. Like when I grew up, you had 5 German marks and you can buy something for 5 German marks. Now you've got 5 euros and you can buy something for 10 euros. Like people lease their cars, the house is owned by the bank, the girls have leased their handbags, the watch is leased. It's all not used anymore. It's all a big bubble, and we pretend to live a lifestyle a lot of people can't afford. And this is the craziness. And if that bubble bursts, we've got much bigger problem than we would have had probably in the 80s or the 70s.